Keep it simple. It's human nature to make things more complicated. In our minds, the more we know, the more we apply to a task, the ability to add to our breadth of knowledge and apply that knowledge should propel us to success and greater success. That is true in a lot of things in life, don't get me wrong. Learning and applying that learning is important, but it can also be a hindrance in other things after reaching an inflection point. Many of you may be familiar with the law of diminishing returns. That law outlines what happens to output for each additional unit of input. From a standing start, a unit of input often leads to a greater productive return. That is the most productive phase. This phase ramps up and gains from our output are encouraging. After the productive phase, you get to a point where an added input adds something less than the greater level of output. That is, you start to see returns, but the trajectory of the returns are less. This is the point of diminishing returns. It is where you start to get less out of more. You are still advancing, but trajectory is less. Then at some point you reach a level where the additional unit of input actually leads to negative returns. In other words, the more you put in, the worse you become. Trading is one of those disciplines that leads to diminishing and then negative returns. In fact, the negative returns can take away all the gains you built up from the ramp-up phases. It is important for you to be aware of that and think in terms of where have I gone too far? That is, where is the additional unit of input leading to more negative returns? Some questions you can ask yourself is, do you find that you have more fear instead of confidence when you trade because you have so many scenarios from your units of knowledge? Another question might be, do you close out trades too quickly because every level from a technical perspective or every fundamental scenario from the abundance of knowledge becomes important to you, and that leads you to hit the exit button right away and too quickly? How about the opposite? Do you not close out trades fast enough because of your internal shift to another unit of input that changes your perspective to fit your losing a trade? I.e., do you take a short-term trade, that is plan A, and make it a long-term trade, that is plan B, because plan A did not work? These things can happen easily in trading and lead to diminishing and negative returns. To solve this problem, one way is to think the opposite. That is, instead of adding units of knowledge to your trading in the false belief that each additional unit of input will lead to a greater unit of output, look to take knowledge and scale it back. That is, subtract units of knowledge, those things that are not important. Be selective. That sounds crazy, I know, to some of you, but it is the essence of diminishing and negative returns. You need to look and find that sweet spot where the path of input still leads to the potential for greater rewards. Now, it is not as simple as I put it, and I hope to give you ideas on how to do this going forward. But to start, if you have the mindset that your units of input, your knowledge, can lead to diminishing and negative returns, you can start to steer clear of making your trading too complicated. So before I take a look at some simple technical levels and some of the major currency pairs going into the new trading week, I want to let all of you know that the Finance Magnates Africa Summit, which will take place in Johannesburg from May 8th to May 10th, is now open for registration. This landmark summit is for businesses like brokers, IBs, affiliates, as well as their customers. That's you. You can read more about it and register as well by going to financemagnates.com, clicking on events, and scroll down to right here where it says Johannesburg. Click on that link and it'll take you to the registration page. It'll be a great event and truly a landmark event and I hope you take advantage of that opportunity. So let's get into some of the technicals that are driving the market in a simple way. So let's take a look at some of the technicals that will be driving the market in trading this week. We just opened up in the new trading day, and we are seeing the euro versus US dollar move a little bit lower. The dollar moving a little bit up to the upside here to start off the trading week. So we'll start by taking a look at the daily chart here of the euro versus US dollar. And the thing that's most simple in my mind here is the low price that we saw a week Friday and the low price that we saw on Monday. Both those levels came in right around the 105.33 level. And in the new trading week, if the price should move to the downside, we are trading again up near the 106.20 level. So it's about 140 pips away. But on the downside, the rising 100-day moving average would be in play. That level comes in at the 104.94 level. Maybe it's a little less than 130 pips away, but we look toward the 100-day moving average near the 104.94 level. That more or less corresponds with this low right here, which came in at 104.84, difference of 10 pips from each of those levels. So that getting below the 105.33 level would have traders looking toward the 100-day moving average and low price from the month of January. That's key. On the top side, there's still a lot of room up to this swing area through here. So let's take a look at the hourly chart and see what clues that is showing to us. And what we see, again, is the euro versus US dollar opening lower. And in the process, we are testing both the 100 and 200-hour moving averages. Those are the blue and green lines here in the hourly chart. The levels come in at the 107 or 105.99 level, looks like, and up to 106.17. That's the 200 and the 100. Current price trading at 106.22, just above the 100-hour moving average of 106.17. So we are trying to find support buyers against this area right through here. If it's able to do that, then we look toward this swing area through here, where we have a number of different swing lows through here, forming a nice little floor here. And then we moved to where we started to use this level as resistance, and once again used it as a floor and got a little sloppy through here, and then used it as a ceiling through here. And trading last week, the price did move above it, and the buyer should have taken the price to the upside, but couldn't do so. And then we started to see more sellers against the top of the swing area through here before moving to the downside. So the sellers the buyers had their shot, the sellers took it back, and then on Friday we saw with the up and down price action, we did close above the moving averages. That gives it a little bit more of a bullish bias, and we'll see in early trading if the price can hold the 200 and 100-hour moving average and keep the bias to the upside. If it doesn't, then we're going to head down toward this swing area between 105.78, 105.85, and then look below that level. We'll start to look toward the low prices that we saw all week from Friday, and on Monday's trade near the 105.32. So that's how I see the euro versus US dollar. Now let's take a look at the dollar versus yen, and we'll start by taking a look at the daily chart. And in this daily chart, it's pretty simple to see, is that the 200-day moving average and the 100-day moving average did a pretty good job of finding resistance sellers against it in trading last week. Price moved up toward it, bounced, moved to the downside, moved up toward it, moved to the downside, moved up toward it, moved to the downside, and we are opening down here near the lows from we saw on Friday's trade. Maybe a little bit higher, but basically below the 100-day moving average and below the 200-day moving average, keeping a lid on that pair. That's what that's going to be the key level on the top side for the dollar versus yen if the price is going to remain, if the bias is going to remain to the downside. By the way, the 38.2% retracement is also in play right near the 100-day moving average. That is of this move down from this high right here to this low right here. So not only do we have the 200, but we also have the 100-day moving average and the 38.2% in play as topside resistance. So bias remains a little bit more or focused to the downside. Let's take a look at the hourly chart and see what the price action here is doing in the early London Asian Pacific session. And what we see is that the price on Friday came right down to test the 200-hour moving average. That's a significant level. Why? Because on this low right here, we found support against the 200-hour moving average, and this low right here found support against it. On this low right back here, the market found support against it as well. So 1, 2, 3, and then 4 different times the price came down to that 200-hour moving average and was finding support buyers, keeps on going higher and higher, but still we're finding that support. And then trading here today, we are trading above it at 135.94. The moving average is currently at 135.78.9. If we're able to break below it with momentum, we look toward this swing area, which has a number of different swing highs through here, and then we found some resistance here and support through here, and found support again against right through here. So we need to get below the 200-hour moving average, then need to get below the 135.11 to 22 level. If we can't get below those levels, then the bias remains to the upside, but there's still some key levels above, including the 100-hour moving average at 136.31, the 100-day moving average at 136.66, and the 200-day moving average at 137.32. All those line up on the top side as well. So there's lots of ups and downs and reasons for these ups and downs in the dollar versus yen, basically outlined by this red box right through here. We need to get out of it. Let's take a look at the sterling versus US dollar. And like the dollar versus yen, the moving averages on the daily chart are in play a number of different times where the market came down to the 200-day moving average. Went a little bit below it here, but held above the 100. Came down to the 200, came down to the 200, came down to the 200, came down to the 200. And in trading here today, you can see that the price is moving away and above the 100-day moving average. It comes in at 109.83. We're going to need to watch that level in the early part of the week. As the price could stay above that level, the bias remains more to the upside in the sterling versus US dollar. On the downside, if we break below that 100-day moving average, you need to get and stay below the 200-day moving average. It's the only way you could say it. And then if we do that, we need to get below this swing area through here with a number of different swing lows through here. And then we moved above it and found the swing highs through, lows through here, and then another low through here. We need to get below the 118.40 down to 117.59 on the wide to get increase the bearish bias there. On the hourly chart, we're opening the week with the price right near the 200 and 100-hour moving averages. That's going to be key barometer for the early part of the week. We did try to close it, or we did close above it on Friday, and then opened up with this gap move to the downside. We'll see if the price can hold support against that level and push back toward our high prices. If the buyers are going to remain in control, if the sellers are going to take back control, we're going to see a price move back toward the 100-day moving average, toward this swing area between the 119.57 to 64 level, and then look toward our 200-day moving average on the downside. Pretty simple, but a cluster of moving averages in between here with 100, 200-hour moving average, 100-day moving average, and then 200-day moving average, all providing target levels or on the downside. And if we get below those levels, more bearish. If we hold above it, guess what? It's more bullish. Let's take a look at the dollar versus Swiss. And again, we'll take a look at the daily chart first. And if we look at that pair, what we did see in trading last week was the price moved up to the 200-day moving or 100-day moving average, a blue line in the chart, and found resistance sellers. We are trading near this swing area down here between the 0.9353, 0.9382 level. If we move below that level, it should increase the bearish bias where we look toward this swing area right through here, where we had a different number of different swing highs in this area right through here. Get below that level near the 0.9287 opens up the door for further downside momentum in the dollar Swiss. We need to get above the 100-day moving average to stay above that level, and then the swing area up through here in order to increase the bullish bias on the daily chart. Right now, the sellers remain more in control in the dollar versus Swiss. Let's take a look at the hourly chart. And what we see on the hourly chart is on Friday, the price fell and closed below the 200-hour moving average. That was somewhat significant, but because the market wasn't running to the downside and we kind of ran out of time, we did not extend much below that level, and the level is going to remain a key barometer in the early part of the trading week. If we move above it and then get above the 0.9369 level, we could see a rotation further to the upside with a 100-hour moving average in play up here, along with this swing area through here between 0.9387 and 0.9393. On the downside, if the market stays and finds more momentum in the downward direction, we look toward this swing area through here, where we had a nice little ceiling through here, and then we had the market make a floor through here with a number of different swing lows before, and so that area between the 0.934 and 0.9348 will be key on the downside in the new trading week. Get below that area, it's more bearish. So take a look at the dollar versus Canada on the daily chart. Lots of ups and downs in trading last week, kind of moving around with the oil prices to the up and down downward direction. We did find a ceiling near the 136.63 level. On the downside, the 100-day moving average is going to be our key barometer, key level from a technical perspective. This is what it looks like on the hourly chart, and what you can see off this hourly chart is the up and down price action that we've been seeing in this currency pair. Not much in the way of directional bias or trend like moves for this pair. We are trading in between the 200 and 100 hour moving average. So as we head into the new trading week this week, we're going to be looking to see if the market can get and stay above the 100 hour moving average, in which case we look toward our high prices, including the high price from Thursday and Friday, and then we start to look toward the high prices from Wednesday's trade and then the high price from the previous week. Those are all on the top side. On the downside, if we should see some dollar selling, we need to get below and stay below the 200-hour moving average, and then look toward ultimately the 38.2% retracement, where we also found support buyers. It wasn't against the 38.2% retracement level, but we did find support buyers in this area right here near the 135.15 level. Needless to say, the 135.15 level is going to be a key level on the downside if the dollar versus Canada is moving in that directional bias. Let's take a look at the Aussie versus US dollar, and similar to some of the other currency pairs, our 100 and 200-day moving averages are in play. The 100-day moving average last week really got beat up a little bit. We do have the Reserve Bank of Australia early this week with the expectations of raising by 25 basis points, so perhaps that had something to do with it. But certainly the market did not want to move away from the 100-day moving average, nor the 200-day moving average for that matter. Each of those levels are going to be key in the early part of the week. If the market's able to get above this level, we should see further momentum up toward the 70, 10 area, 12 area, where these different swing highs came in. If we get above that level, then we start to look toward the high price from last week near the 71.57 level. Actually, this is not last week. This is the daily chart. But we look toward the 70 level, get above that level, and we start to look further to the upside here. But we need to get above the 200-day moving average. On the downside, we have this swing area between the 0.6628 and 0.6678 is sort of where I'm targeting on the downside, and further momentum in the early part of the trading week on more bearish bias for the Aussie versus US dollar. Take a look at the hourly chart, and similar to other charts that we've seen as well, is the 100 and 200 hour moving average kind of came in play as a result of the non-trending type price action in trading last week, where the market moved up and down, up and down, up and down. The 100 and 200 hour moving average is currently come in at 0.6742, 0.6767, currently trading at 0.6754. So in between those two moving averages, we tried to move higher toward the close of Friday's trade. And this week, though, however, we are opening up a little bit to the downside. If we get below both the 100-day moving average and 100-hour moving average near the 0.6742, 0.6748 level, then that would increase the bearish bias, look toward our low prices. If we are able to get and stay above the 200-hour moving average of 0.6767, we'll look toward the high price of last week at 84, and then the 100-day moving average, and we get above that, or 200-day moving average, get above that, we'll look toward the 0.6822 level. That's a 38.2% retracement of this move down from the high price that we saw on February 14th to the low price that we saw on beginning of March. So that's the Aussie versus US dollar. And finally, for the New Zealand versus US dollar, the 100 and 200-day moving average again coming in play along with this swing area. The swing area comes between 0.6184 and 0.6212. The 200-day moving average is just outside of that on the downside, 0.6174, and the 100-day moving average is just outside of that range again at 0.6223. So this area between the 200 and 100 are key barometers for the early part of the week for the New Zealand versus US dollar. Move above it, it's more bullish. Move below it, it's more bearish. That's the simple way of looking at the New Zealand versus US dollar to start off the trading week. Finally, we'll take a look at the hourly chart, and similar to what we saw on a lot of different other pairs, not only do we have the daily moving averages in play, we also have the 100 and 200 hour moving average, which is converged near the 0.6308ish 10 level somewhere in there. Here's a 100-day moving average just above it. Here's a 200-day just below it. So once again, pick your moving average. But if the market moves below those levels, We look toward the 200-day moving average. If market stays above this level and get above the 100-day moving average, it opens the door for further upside in the New Zealand versus US dollar. So there you have it. A look at all the major currencies from a daily and hourly perspective. Hopefully it is fairly simple. We saw a lot of moving averages in play, not only from the hourly perspective, but from the daily perspective. I hope I get your week off to a good start from a technical perspective. My name is Greg Michaelowski. Good fortune with your trading. Bye-bye now.